What if you could get a peek into the future of the global economy? Well, back in February 2026, one financial report claimed to do just that. It predicted a massive split, something it called the Great Bifurcation. Today, we're going to unpack its analysis, its models, and its really bold predictions for the year.
This is the very first line of the report, and man, does it set the stage. It argues that on one side, you have this absolutely immense force, the AI revolution, pushing us into a new era of growth. But on the other side, you've got geopolitical chaos and stubborn inflation trying to drag the whole thing down. And that collision, that's the heart of what we're exploring today.
So, just to be super clear, our job here is to be your guide through this specific report from this exact moment in time. We're not making our own calls or breaking down how it saw the world unfolding for the rest of 2026.
Okay, so you might be wondering, how on earth did the report justify such a dramatic prediction? Well, it starts by looking at two major economic forces that it claims were pulling the market in completely opposite directions, creating a kind of perfect storm. Now, this is where it gets really interesting, because it presents this huge paradox. Picture two powerful ocean currents crashing into each other. One is the short-term 9.2-year stock cycle. The report says it was peaking and pulling the market down, but smashing right into it was a massive long-term tech wave, the quantitative wave, which was just starting a new spring thanks to AI. So one current says down, the other says way up. That's the central conflict.
But the analysis didn't just stop at the numbers. The report leaned heavily on this fascinating theory called socioeconomics. The basic idea is that the collective social mood is what really drives everything else. You ever notice how when everyone's feeling optimistic, things just seem to go right? That's pretty much socioeconomics in a nutshell. And when that mood sours, well, that's when you see conflict, more regulation, and market downturns.
And according to the report, the warning signs were already there. It points to things like the California Attorney General going after Elon Musk's XAI or Nevada authorities suing prediction markets like Kalshi. The report's take was that these weren't just random, isolated incidents. No, this was a classic pattern. Society was shifting away from anything-goes innovation and more towards control. And that is a classic red flag for a market top.
So this brings us to the biggest story of our time, artificial intelligence. But the report gives us a pretty stark warning here. Looking at AI as just one single thing is a huge mistake. Instead, it tells a tale of two very different bubbles, heading in completely opposite directions.
This quote right here, which the report highlights, is the key to understanding its whole AI forecast. I mean, think about it. What happens when the CEO of a top AI company says that half of all enterprise software is about to become obsolete? You get this crazy mix of incredible optimism and deep, deep fear, all at the same time. Optimism for the new AI stuff, and fear for the old software giants.
So this is the core idea: selective collapse. The report predicted a massive boom for the physical infrastructure of AI. The companies making the chips like NVIDIA and TSMC, the data centers, and, super important, the energy companies powering it all. But at the same time, it forecast a bubble bursting for software companies like Salesforce and Adobe because they were facing the direct threat of being replaced by AI. See? One side booms, the other side busts.
Okay, so now let's get down to the hard numbers. This is where the report takes all these theories and turns them into specific, testable predictions using some really, really complex models.
And yeah, those models were flashing some serious warning signs. Using a pretty sophisticated simulation, the report calculated a 38.7% probability that the market would shift into a downturn within the next 3 months. Now, to put that in perspective, that number had surged, mostly because geopolitical risks were pushing up oil prices. The clock was ticking.
And this just shows you the level of analysis we're talking about. The report was using Nobel Prize-winning economic models, like the one you're seeing, to map out exactly how a shock in one area, like oil prices, would ripple through the entire global system of inflation, interest rates, and stock prices. And right here in the US, this whole bifurcation created a tale of two different economies. The report was bullish on the old economy. We're talking energy and industrial companies, which were getting a boost from a new investment deal with Japan and policies that favored manufacturing at home. But it was pretty bearish on tech and software, which were getting squeezed by both regulators and the AI disruption we just talked about. Looking beyond the US, the report painted a pretty challenging picture. For Europe and the UK, it was forecasting deeper stagflation. For China and Hong Kong, this slow, grinding, L-shaped recovery that just couldn't get going.
And South Korea was a market of total contrasts, with its chip sector booming while everyone at home was struggling.
Of course, this global divergence showed up in the currency markets too. As you can see here, the baseline assumption was a strong US dollar, mainly because of all the geopolitical uncertainty. And that meant the report was predicting weakness against the dollar pretty much across the board, for the Korean won, the Japanese yen, the Chinese yuan, and the euro.
So, after all this deep analysis of cycles and social mood and markets, what's the ultimate takeaway? What does it all boil down to? It all comes down to a single, really powerful idea.
I think this line just perfectly captures the entire thesis. 2026 was going to be the year where the tangible physical world with its energy costs and inflation and conflict was going to collide head-on with the digital world of AI hype and market expectations, a real gut check for what has actual value.
So what was the bottom line? The report's strategy was simple. Focus on real assets. Not the software getting replaced, but the physical infrastructure making AI possible. The chips, the data centers, the power plants. It also highlighted energy, hard assets like gold as a hedge, and short-term treasuries just to have cash ready. In a world of digital hype, the report's advice was to bet on the real. And this brings us to the final, really thought-provoking question posed by the report. As we build this world that's increasingly powered by digital abstractions, what's the fundamental value of the physical, tangible reality that holds it all up? That's a question we're thinking about as these powerful forces continue to shape our world.